Fixed rate mortgages can get hit with massive penalties. I'm going to share with you a strategy that I'm using right now in real time to guarantee that I do not pay a massive penalty when I sell my house in the next 120 days. So yesterday I called the bank manager, the branch manager where I have my mortgage, which is a BMO, and I made some moves to make sure that I won't have a massive penalty. I essentially guaranteed a 3 months interest penalty. So I'm going to share with you what I did. Now, first thing you need to know is how fixed rate penalties actually work. So the way it works is when you get a fixed rate mortgage, lenders have a posted rate that's quite high. Nobody actually gets that. They give you a discount and then you get the rate you actually get. The discount that you got sticks with your mortgage. And the way it works when you go to break your mortgage is you have your rate. And the lender is going to say, hey, you're breaking your mortgage. You owe us whatever your rate may be. So in this case, let's say it's 5%. What they're going to do is they're going to say, okay, you owe us 5%. Or they're going to look at the most comparable posted rate. So let's say you have a 5-year fixed, 2 years has gone by, they're going to look at the 3-year posted rate. If that 3-year posted rate's, let's say 3.5%, they're going to go, okay, great. We can earn 3.5% if you pay us the money back, but we give you a discount. So let's say that discount is 2%. They're going to go like this. So they're going to say that your penalty is going to be the rate that you owe minus essentially the amount of money they can earn. So in this case, it would be 1.5%. So they're going to go minus 1.5. In this case, you would owe 3.5% of your mortgage balance per year left remaining. So if that was a 3-year mortgage, this is basically a 10% penalty. So that would equal 10.5% of the mortgage balance. Now, this is just an example I'm making up off the top of my head. Most penalties aren't this big right now, but they could be. So you have to be very careful. Now that you know how penalties work, I'm going to dive into what I actually did. So the important thing to know is I have what's called a readvanceable mortgage. So I have a big, fat, way too big mortgage of about 500, and I think it was 25,000 roughly. These are just rough numbers. And I have a line of credit that is interest only. I owe 0 on it, but the limit's about 40,000. So what I did was I called, and I guess you should know, my rate's 5.09 on the mortgage, and my line of credit is 4.95%. So what I did was I called the branch manager, and I had them use, if I were to do this manually, it'd take a long time, but they used the line of credit, and they paid off 65% of the original value of my home. So in this case, it worked out to be about $450,000. So this became about $450,000. And this became about 80,000. So what I did was I moved the vast majority of my mortgage debt from the mortgage over to the line of credit. Not only am I saving a very small amount on the interest rate, that's not the primary reason I'm doing it. The reason I'm actually doing it is I know for sure I'm going to be selling my property. So I was able to guarantee a $4,400 penalty that I've paid now, which is 3 months interest. But if the lender cuts their posted rates, so like this formula up here that we have, if they cut posted rates, so they're going to look at the most comparable term. So if this number is currently 5%, let's say, or 6%, and they lower it, it can create this massive penalty. So what I did is to prevent them being able to do that and putting me in a position where I might have a $30,000 penalty or something silly, I triggered this early by moving the debt over to my home equity line of credit. Now, there's a few extra things I did to make this better. The first thing I did was I made them move the 20% of the home equity line of credit first. So essentially that's my prepayment, 20% of the original mortgage amount. So first step, I had them prepay this mortgage down 20%. That's penalty free. Then I had them remove the remaining amount that they could, which mitigated my penalty a little bit. The second thing that I did, and this won't work for everybody, but I have to pay about $2,000 per month in interest on the money I moved over to my line of credit, and my mortgage payment's about $3,050 per month. I had the option to lower it if I wanted to, but knowing that I'm going to be selling my house in the next 120 days, I don't really care because I have the money saved up to cover these payments for the next few months. I can lower the payment at any time by just calling them if I need to. And I know that about 90% of this $3,050 is going towards paying off the debt right now because I owe very little. I owe about 80 grand. So what they're doing is they're calculating the interest on that 80,000. It's relatively small. The rest goes to principal. Now, it's not free. I moved the money over to the HELOC, so I need to make the payments there. But what it did is it almost doubles the cut they would need to do for me to trigger an interest rate differential on the 80,000 that I can't move over with this strategy. So I know this is a lot, but I promised you guys I'd make a video today and send it out. I'll probably do another version of this that makes a little more sense. It's been a long day getting ready to move and just dealing with work and everything, but I wanted to share with this the power of a readvanceable mortgage and how you can use this to be proactive if you know you're going to break a mortgage to guarantee the smallest penalty possible versus being in a position where you're reactive and a lender can move you from, say, a $5,500 penalty to a $35,000 penalty. So if you have any questions, if part of this doesn't make sense, let me know. Send me a message or leave a comment. I will make a better version and I will get you an answer. But hope this helps.